Hey everyone, welcome back to Corporate Decoder, the place where we decode the financials and expose the stories hidden in plain sight. Today we're diving into nVent Electric PLC's latest quarterly report, and let me tell you, they've been busy. We're talking about big acquisitions and some interesting shifts in their business. nVent Electric PLC is a company that makes electrical connection and protection solutions. Think of them as the backbone for keeping our electrical systems safe and running smoothly. They operate in two main areas, which they've recently renamed. Their systems protection segment, formerly Enclosures, focuses on protecting electronics and data in critical places like data centers, using things like protective enclosures and cooling systems. Then there is Electrical Connections, previously Electrical and Fastening Solutions, which is all about connecting power and data infrastructure with products like cable management and power connections. This report covers the period ending the 30th of September 2025, giving us a look at their performance over the first 9 months of the year and the third quarter specifically. Overall, nVent is showing some strong growth, particularly driven by their acquisitions. Let's jump right into the money numbers. For the third quarter, net sales shot up by a massive 34.8% compared to the same time last year, reaching $1,054.0 million. And for the first 9 months of the year, net sales were up 25.4% to $2,826.4 million. This huge jump in sales is largely thanks to two major acquisitions, TrackDay, which they bought in July 2024, and the Electrical Products Group acquired in May 2025. These two brought in about $139.1 million in sales in the third quarter alone, and a staggering $363.9 million for the 9-month period. On top of that, they're seeing solid organic growth, especially in their infrastructure business. This means their core business itself is growing alongside the acquisitions, which is a great sign. Now, while sales are booming, their gross profit as a percentage of net sales took a slight hit. It dropped to 37.4% in the third quarter from 39.8% last year. And for the 9 months, it went from 40.4% down to 38.2%. The company blames this on inflationary cost increases for things like raw materials and labor, as well as investments they're making to expand their capacity. However, they've managed to partly offset these by increasing sales volume and improving productivity through better supply chain management and manufacturing efficiencies. It is a balancing act, but the overall increase in gross profit dollars, despite the slight percentage dip, shows they are still bringing in more profit in absolute terms. When we look at selling, general, and administrative expenses, also known as SG&A, things get a bit more complex for the third quarter. SG&A as a percentage of net sales actually decreased slightly to 19.7% from 20.7% last year. This is good news, showing they are getting more leverage from their sales growth. However, for the first 9 months, it crept up a tiny bit to 20.2% from 20.0%. This is partly due to increased intangible amortization, which is a cost associated with their acquisitions. Think of it as spreading the cost of those acquired brand names and customer relationships over time. They also faced higher labor costs and other administrative expenses, along with investments in new products and digital transformation. Despite some of these cost pressures affecting gross and SG&A margins, nVent Electric's operating income saw a healthy increase. In the third quarter, it rose by 24.8% to $166.3 million. For the 9-month period, operating income grew 10.5% to $453.0 million. This shows that while their profit margins might be under a little pressure, the sheer volume of sales is driving overall profitability higher. One of the most significant events impacting their financials is the sale of their thermal management business. This sale, which was finalized on the 30th of January this year, brought in a massive $1.7 billion in cash. As a result, the financials show a huge boost in income from discontinued operations. Net of tax, for the 9 months ending September 2025, this income was $278.7 million, largely due to a pre-tax gain of over $435 million from the sale itself. This transaction significantly boosted their net income for the period, making the overall net income jump by 84.2% to $591.4 million for the first 9 months. Let's break down those segment results. The Systems Protection segment, which includes the new acquisitions, saw its net sales soar by 50% in the third quarter and 36.7% for the 9 months. This is driven by acquisitions and strong organic growth in their infrastructure business. However, segment income as a percentage of net sales decreased slightly, mainly due to those inflationary cost pressures and investments in growth. The Electrical Connections segment also showed good growth, with net sales increasing by 11% in the third quarter and 8.3% for the 9 months. This segment is also benefiting from organic growth in the infrastructure business and sales from the recent Electrical Products Group acquisition. Similar to systems protection, segment income as a percentage of net sales saw a small dip due to cost increases, but it is still a strong performer. Looking at cash flow, nVent generated a solid $426.6 million from continuing operations in the first 9 months of 2025. This is up from $324.1 million the previous year. This increase reflects the higher net income with adjustments for non-cash items, even with a slight increase in working capital, like higher accounts receivable due to increased sales. Their operating cash flow remains robust. Investing activities show a dramatic shift. In the first 9 months of 2025, they used $1,029.8 million for continuing operations, mostly for the Electrical Products Group acquisition and capital expenditures. But get this, they provided $1,584.5 million from discontinued operations, thanks to the proceeds from selling the thermal management business. This essentially means the sale of one business funded significant investments in others. Financing activities in 2025 show a significant outflow of $909.6 million. This is largely due to repaying $869.7 million of long-term debt, along with share repurchases of $253.1 million and dividend payments of $98.0 million. This shows they are actively managing their debt and returning capital to shareholders. Speaking of share repurchases, nVent has been actively buying back its own stock. They repurchased 4.8 million shares for $253.1 million in the first 9 months of 2025 under their 2024 authorization. This is a move often seen when a company believes its stock is undervalued or wants to boost earnings. Per share. Their debt situation is also interesting. As of the 30th of September 2025, total debt stood at $1,593.3 million, a decrease from $2,155.0 million at the end of 2024. They've been actively paying down their borrowings, particularly from their term loan facilities. They are in compliance with all their financial covenants, which is crucial for maintaining investor confidence. Okay, so what is the big picture here? nVent is definitely in a growth phase, aggressively acquiring companies and seeing strong sales across the board, especially in infrastructure markets. The sale of the thermal management business was a game changer, providing a huge influx of cash that is fueling expansion and debt reduction. Their core businesses are also performing well, showing solid organic growth. However, we do see some pressure on their profit margins due to inflation and strategic investments. They're managing this through price adjustments and productivity improvements, which is key. The increase in SG&A, particularly from amortization of newly acquired intangible assets, is something to watch, but it is a typical consequence of growth through acquisition. Overall, nVent Electric appears to be executing a clear strategy of growth through acquisition and organic expansion, while also focusing on operational efficiency and returning capital to shareholders. The company seems well positioned to capitalize on megatrends like electrification and sustainability. What do you think about nVent Electric's current strategy and their latest financial results? Do you believe their acquisitions will continue to drive growth and profitability, or are the cost pressures a concern? Let me know your thoughts in the comments below. If you found this breakdown insightful, please give this video a thumbs up and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description, for more discussions and analysis. Thanks for watching, and we'll see you in the next one.